A Beginner's Guide to the Stock Market by Matthew R. Kratter. Picture this: a man named Ronald Reed spending his days pumping gas and mopping floors at J.C. Penney. He drove a beat-up car, fixed his coat with safety pins, and lived so modestly that his neighbors thought of him as just another friendly guy scraping by. Then he died at 92, and everyone's jaw hit the floor. This humble janitor had secretly amassed $8 million. No lottery win, no rich uncle, just a simple habit that anyone could have copied. Ronald Reed discovered something most people never learn. The stock market isn't just for Wall Street sharks in expensive suits. It's actually the most democratic wealth-building machine ever invented, and he proved it by turning pocket change into a fortune that would make most executives jealous. That's the heart of what Matthew R. Kratter wants you to understand in his book. Kratter runs something called Trader University and spent over 20 years swimming in the deep waters of finance, including time at hedge funds. But he wrote this guide because he's convinced that financial freedom shouldn't require a Harvard degree or a trust fund. It should be available to the gas station attendant, the student drowning in debt, anyone willing to learn. Here's the problem, though. For most of us, the stock market feels like trying to read ancient hieroglyphics. Bulls, bears, moving averages, P/E ratios. It's like everyone's speaking a foreign language designed specifically to make you feel stupid. And then there are the horror stories, right? People losing their life savings overnight, markets crashing, fortunes evaporating like morning fog. Kratter wants to change that. He's handing you the decoder ring, the secret password, the key to a world that's been hiding in plain sight. And here's the beautiful part. Once you understand the basics, it's not nearly as complicated as the experts want you to believe. So forget everything you've seen in movies about frantic traders screaming into phones. For the next little while, we're going to walk the same path Ronald Reed walked. We'll start small, think clearly, and learn the surprisingly simple principles that can transform modest savings into serious wealth. By the time we're done, you won't just understand what stocks are. You'll have a complete roadmap showing you multiple paths forward. Whether you want to build wealth slowly while you sleep, or take a more hands-on approach that could potentially accelerate your journey. This isn't just about making money. It's about understanding how the modern economy actually works, and more importantly, how to make it work for you. Let's start with the most basic question. What in the world is a stock, really? Kratter asks you to imagine McDonald's as a giant pie. Not metaphorically giant. Literally imagine the entire company as one enormous pie. A stock is simply one slice. When you buy a share of McDonald's, you're not just getting some abstract financial instrument. You're becoming a part owner of actual restaurants, actual French fry machines, actual golden arches scattered across the planet. Buy enough slices, and theoretically, you could own the whole pie and become the burger emperor. Now, the price of each slice. That's constantly bouncing around. Why? Because millions of people and incredibly sophisticated computers are processing news, rumors, and data every single second, collectively deciding what the entire pie is worth. McDonald's launches an amazing new burger that goes viral. The pie just got more valuable, so each slice costs more. They report disappointing sales, the pie shrinks, and slice prices drop. This total value of all the slices combined is called the market capitalization, or just market cap. When news anchors breathlessly report that Apple hit $1 trillion valuation, they're talking about what the entire pie would cost if you bought every single slice. But here's where it gets interesting, and where most beginners get completely confused. The legendary hockey player Wayne Gretzky once said, "I skate to where the puck is going to be, not where it has been. The stock market does exactly the same thing. It's always looking forward, trying to predict the next 3 to 6 months. This creates situations that seem absolutely bonkers. A company announces record profits, better than anyone expected, and the next day the stock price crashes. What gives? Simple. Somewhere in that announcement, maybe in the CEO's voice during the call, maybe in a footnote about future challenges, the market heard something that suggested trouble ahead. While everyone else was celebrating yesterday's success, the market was already skating toward where the puck is heading next. Your job, as an investor, learn to skate like Gretzky, not like everyone else. So how do you actually get in the game? How do you buy your first slice of pie? You need a middleman called a broker, but don't worry, you're not calling some guy in a pinstripe suit anymore. Companies like Robinhood, Charles Schwab, or Fidelity let you open an account from your couch, in your pajamas, while eating actual pie if you want. Many don't even charge fees anymore, which is a complete game changer for people just starting out. Once your account is open, you face your first crucial decision. When you're ready to buy a stock, you'll see two options: market order or limit order. This choice matters more than you might think. A market order basically says, get me this stock right now, I don't care what it costs. A limit order says, I'll only pay this specific price or less. Why does this matter? Because every stock has two prices happening simultaneously. There's the bid, what buyers are willing to pay, and the ask, what sellers want. The gap between them is called the bid-ask spread. For hugely popular stocks like Apple, that spread might be a single penny. No big deal. But for lesser-known stocks that don't trade as much, that spread could be enormous. Imagine the bid is $50, and the ask is $52. You place a market order to buy, you get filled at $52. Immediately change your mind and place a market order to sell, you'll get $50. The stock didn't move at all, and you just lost money. Kratter's advice is crystal clear. Until you really know what you're doing, almost always use limit orders. It's like having a safety net that protects you from hidden costs and sudden price spikes. All right, you've got your account set up, you know how to place an order. Now comes the million-dollar question. Literally, what should you actually buy? For most people just starting out, Kratter suggests something that might sound boring but is actually brilliant. Don't try to pick individual stocks at all. Instead of searching for the needle, just buy the entire haystack. You do this through something called an index. An index is just a pre-made basket of stocks. The most famous is the S&P 500, which contains the 500 biggest, most influential companies in America. Trying to buy all 500 yourself would be a nightmare of logistics and fees. Fortunately, there's this genius invention called an ETF, or exchange-traded fund. An ETF is a single stock that represents an entire basket. Want to own a piece of all 500 companies in the S&P 500? Just buy one stock with the ticker symbol SPY. More interested in big tech companies like Apple, Google, and Amazon? Buy the NASDAQ 100 index through QQQ. This approach is called indexing, and it's a form of passive investing. You're not trying to be clever or outsmart anyone. You're simply accepting whatever the overall market returns, which historically has been pretty darn good. To make it even more effective, many people use something called cost averaging. That's just a fancy way of saying you invest the same amount every month, say $100. When the market is expensive, your $100 buys fewer shares. When there's a dip, your $100 buys more shares. Over time, this smooths everything out and gives you a solid average price. Buying something like SPY and just leaving it alone for 30 years is genuinely one of the most reliable ways to build wealth that anyone has ever discovered. But maybe you want something more personal. Maybe you want to feel more connected to your investments, like Ronald Read did. That brings us to the second path, dividend investing. This was Ronald Read's not-so-secret weapon. Some companies, usually the older, more stable ones, decide to share their profits directly with their owners. These cash payments are called dividends, and they typically show up in your account every 3 months. When you own dividend stocks, money just appears, regardless of whether the stock market is having a good day or a terrible one. It's like owning a rental property, except you never get a midnight call about a broken water heater. The real magic happens when you take that dividend cash and immediately use it to buy more shares of the dividend-paying stock. Those new shares then pay you even more dividends next quarter, which you use to buy even more shares. It creates this beautiful snowball effect, growing larger and faster as it rolls forward through the years. That's how Ronald Read transformed a janitor's modest paychecks into $8 million. The best dividend companies don't just pay dividends, they raise them every single year. There's even an elite club called the Dividend Aristocrats, companies that have increased their dividend every year for at least 25 consecutive years. We're talking about household names, Coca-Cola, Johnson & Johnson, McDonald's. You can even buy a basket of all the Dividend Aristocrats through an ETF with the ticker NOBL. When a company can send you real cash every single quarter for decades, raising the amount each time, that's a pretty reliable signal that it's a healthy, profitable business. After all, you can't fake cash in your account. This brings us to the third path, championed by the most famous investor on the planet, Warren Buffett. His strategy sounds almost too simple. Find an excellent company, buy it at a reasonable price, and then just hold it for decades. Of course, the tricky part is figuring out what makes a company excellent and what price counts as reasonable. Buffett's secret weapon is something he calls pricing power. It's the ability to raise prices without losing customers. Think about the difference here. If your local gas station raises prices by 10 cents, you'll probably drive across the street to save money. Gas is gas. It's a commodity. But when Apple raises the price of the new iPhone, people camp outside stores to buy it. When Coca-Cola costs a bit more, you probably don't even notice. That's pricing power. Buffett has a great line about this. If you need to have a prayer session before raising your prices by 10%, you've got a terrible business. So how do you invest like Buffett? Kratter offers a brilliant shortcut. Just copy him. Every year, Buffett's company, Berkshire Hathaway, publishes a letter to shareholders listing every major stock he owns. You can literally peek at his homework. Stocks like American Express, Apple, Bank of America, Coca-Cola, and build your own similar portfolio. Even easier? Just buy shares of Berkshire Hathaway itself, ticker symbol BRKB, and let the master do all the work while you relax. Now, these first 3 strategies, indexing, dividend investing, and the Buffett approach, are all part of what's called long-term investing. Buy and hold, sometimes for decades. But there's another world, a faster-paced universe called trading. Traders hold stocks for shorter periods, months, weeks, days, sometimes just hours. Kratter emphasizes that neither approach is superior. They're just different tools for different goals and different personalities. Let's explore some of the traders' tools. Many new traders get seduced by something called value investing, which sounds sensible. Buy things for less than they're worth. This often gets misunderstood as simply buying stocks that look cheap, specifically stocks with a low price-to-earnings ratio, or PE. The PE ratio just compares a company's stock price to how much profit it makes. A low PE supposedly means you're getting a bargain. But Kratter issues a serious warning. For beginners, stocks with very low P/E ratios are almost always traps. They're cheap for a reason. These are usually companies drowning in debt, selling outdated products, or watching their revenues vanish. He gives a perfect example from 2009. You could buy shares in Blockbuster Video at a super low P/E of just 2, looked like an absolute steal. Or, you could buy shares in this newer company called Netflix at a much more expensive P/E of 26, which was the better choice. Blockbuster looked cheap because its earnings were about to disappear completely as the entire business model collapsed. Netflix looked expensive because its earnings were about to explode upward. Buying cheap stocks that are heading towards zero is never a bargain, no matter how cheap they get. This is what's called a value trap, and it's claimed countless victims. A much more powerful strategy for traders, Kratter argues, is focusing on growth stocks. These are companies rapidly expanding their revenues and earnings. And here's the first rule. Completely ignore the high P/E ratio. Great, fast-growing companies almost always look expensive by traditional measures. Amazon traded at sky-high P/E ratios for years, and it made long-term shareholders incredibly wealthy. So how do you trade these rocket ships? Kratter's approach is counterintuitive, but powerful. He actually likes buying growth stocks when they're hitting new 52-week highs, or even all-time highs. This sounds crazy to most people. Isn't buying at the absolute peak incredibly risky? But think about the psychology for a moment. When a stock is at an all-time high, every single person who owns it has a profit. Nobody's sitting there frustrated, waiting to dump their shares just to break even. The only people in pain are the short sellers, traders who bet against the stock. As it climbs higher, they're forced to buy shares to cover their losses, which adds even more rocket fuel, pushing the price higher still. To do this safely, Kratter uses simple technical guideposts. He only buys if the price is above something called its 50-day moving average, and that 50-day is above the 200-day moving average. Don't worry about the math. It's just a simple visual check confirming the stock is in a healthy uptrend. A growth stock in a downtrend, by contrast, is one of the most dangerous things in the entire market. An even more volatile playground for traders is the world of IPOs, or initial public offerings. This is when a private company first offers its shares to regular people like us. There's usually tons of media hype around big IPOs, like Uber or Facebook. But Kratter warns that an IPO is often a giant transfer of wealth from what insiders call the dumb money, that's us regular folks, to the smart money, the company founders and early investors who are cashing out. You have to ask yourself, if the company's future is so incredibly bright, why are the people who know it best selling their shares? The nature of IPOs has changed dramatically too. Amazon went public just 3 years after it was founded, with a tiny valuation of around $438 million. This let public investors ride its incredible journey to becoming a trillion-dollar company. Compare that to Uber, which stayed private for 10 years and went public already valued at over $80 billion. Most of the explosive growth happened while regular people couldn't invest. For traders, though, the small number of shares available after an IPO, called a small float, can create massive volatility, which means both huge risk and huge opportunity if you have strict discipline and use stop losses. Finally, Kratter shares one of the most intriguing strategies in the entire book, a way to make money from a stock that's going absolutely nowhere. Let's say a stock has been stuck trading between $45 and $50 for months, just bouncing around in this range like it's trapped in a box. You can use something called a covered call strategy. The mechanics are a bit advanced, but the concept is simple. You buy 100 shares of the stuck stock. Then you sell someone else the right, but not the obligation, to buy those shares from you at a slightly higher price, say $50, by a certain future date. This is called selling a call option. For giving them this right, you get paid cash up front. If the stock stays flat or goes down and never reaches $50, the option expires worthless, and you just keep the cash premium you were paid. Plus, you still own your original shares. It's a way to generate income from stocks that are just bumbling along doing nothing. Whether you choose the path of the patient long-term investor or the more active short-term trader, your success will ultimately depend less on picking the perfect stock and more on avoiding critical mistakes. Kratter concludes his guide with what he calls the 5 commandments for beginners, 5 rules you should write down and stick to your computer screen. First, don't buy stocks hitting 52-week lows. Trying to catch a falling knife is a recipe for bleeding money. Bad news travels in packs, and there's never just one cockroach hiding in the kitchen. Second, don't trade penny stocks. These are stocks trading for under $5, and they're a minefield of fraud, terrible companies, and wild volatility. You're far better off buying 1 share of a $100 stock than 100 shares of a $1 stock. Third, don't short stocks. Shorting means betting a stock will go down, and it's advanced for one simple reason. Your risk is unlimited. Buy a stock, and the worst case is you lose what you invested. Short a stock, and it can theoretically go up forever, and your losses can exceed your entire account balance, actually putting you in debt to your broker. Fourth, don't trade on margin. Margin is just borrowing money from your broker to buy more stock. It amplifies everything. It doubles your gains when you're right, but it doubles your losses when you're wrong, which can wipe out new traders faster than you can blink. And fifth, perhaps most important, don't trade other people's ideas. That hot stock tip from your neighbor or something you saw on television is worse than useless. Even if the idea happens to be good, you won't have the personal conviction to stick with it when things get rough, because you didn't do the research yourself. True financial freedom doesn't come from being handed a fish. It comes from learning how to fish. Stepping back and looking at everything Matthew Kratter has laid out for us, the overwhelming feeling is one of genuine empowerment. The stock market, so often portrayed as this exclusive casino where only insiders win, turns out to be something completely different, a tool, a powerful wealth-building tool that, in our modern age, is genuinely available to anyone with a smartphone and some curiosity. What strikes me most about Kratter's message is his deep respect for individuality. He doesn't preach one single correct path to success. Are you patient, risk-averse, and happy to build wealth quietly over decades like Ronald Reed? Then dividend investing or indexing is your path. Do you have a talent for spotting future trends and a stomach for risk? Maybe growth stock trading is calling your name. The book's core philosophy is that market success comes from self-knowledge, finding the strategy that matches your psychology, your timeline, and your tolerance for watching your account balance bounce around. The most potentially life-saving part of this guide is that final section on the 5 huge mistakes that beginners make. These 5 rules are like guardrails on a mountain highway. They won't guarantee you'll reach your destination, but they'll dramatically reduce your chances of careening off a cliff. The warning against catching a falling knife by buying stocks at 52-week lows is a lesson that has saved disciplined investors fortunes, while ignoring it has cost emotional investors just as much. It's a simple, powerful reminder that in the stock market, what's popular is often profitable, and what's cheap is often cheap, for a very good reason. So where do you go from here? The journey from small beginnings to substantial wealth doesn't start with a giant leap. It starts with one manageable step. Here are a few you can take today. First, open a brokerage account. You don't even need to put money in it right away. Just go through the process. Demystify it. See for yourself that it's not some exclusive club with secret handshakes. Second, when you're ready, put in a small amount of money, an amount you'd be completely okay losing, maybe 50 or $100. Use it to buy one share of an ETF like SPY. Just one. Experience what it feels like to be a part owner of the 500 biggest companies in America. Watch it move up and down, not with fear or greed, but with curiosity. This single action will teach you more than reading a dozen books. Third, pick one strategy from this book that really resonated with you and start learning more about it. Did the idea of dividend aristocrats spark your interest? Google the list. Read about those companies. You don't have to invest a single penny yet. Just begin the process of learning to fish for yourself. That was a summary of A Beginner's Guide to the Stock Market by Matthew R. Kratter. We've touched on the core ideas today, but a summary is like looking at a travel brochure. It can show you beautiful pictures and describe amazing destinations, but it can never replace the experience of actually taking the journey yourself. The real value of this book is in the clarity and simplicity with which Kratter explains each concept, turning what feels impossibly complex into something you can genuinely grasp. This summary is your map, designed to help you decide if this is a journey you want to take. If anything we've talked about has sparked your interest, or made you feel that maybe, just maybe, this world isn't as intimidating as you thought, then I'd encourage you to pick up a copy. Reading it isn't just about learning facts. It's about taking that first crucial step toward your own financial future. And if you found this exploration valuable, I'd be grateful if you'd hit that like button and subscribe to the channel, so you won't miss our next deep dive into another potentially life-changing book. Let's keep learning and let's keep growing together.